one of the risks in retirement, sure you've seen it in your business, is sequence of return risk. Once you start drawing out of that pot, then the returns matter a lot. And if you're unlucky enough to have a big downdraft in the market right after you retire and you're drawing down, you're just doubling down on a down market, and you could really run out of money quickly. So what we discovered is to use a reverse mortgage credit line almost like a buffer asset. In other words, when the market goes up, draw from your 401k. But when the market is down, don't draw from your 401k. Leave the money in the 401k to let it recover, but draw from your reverse mortgage credit line.
Welcome to Redefine Retirement with Ryan Wheless, powered by Allied Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Welcome to Redefine Retirement with Ryan Wheless. Today I'm joined by Pete Neuwirth, a Harvard-educated actuary with 38 years leading firms like Cigna, Ion, and Towers Watson. He retired in 2016 and is the author of What's Your Future Worth and Money Mountaineering. He also blogs on financial wellness and consults on holistic planning and economic crisis. A fellow of the Society of Actuaries, Pete, welcome to the show. You've got a finite amount of time and a finite amount of resources, and we don't know when those two lines are going to cross.
Well,
right?
And the problem is you don't even know how. It's finite but undeterminable. You may have there's some things you know how much money you've got. You may know how much income you can produce depending on the investment you put that in. And if you buy an annuity, you can deploy those assets and then turn that into a stream of income that will last the rest of your life, because there are insurance companies that are out there taking on that risk. And that's why I call annuities longevity insurance.
And I agree with you. It's interesting to me. Let's go back to what you said, because I'm a big fan of this, right? And not necessarily a fan. I guess I'm a student of the same. Because in 1978, they did add the Internal Revenue Code, the 401k or Section K 401k plan. And you mentioned that prior to that, your company handled your defined benefit plan, which was your pension, and you worked for 30, 40 years at the same company. You retired, you got your gold watch, your pension covered 80% of your salary. And it would cover usually 100% until you got to Social Security age. Then there was the Social Security offset. So the pension was reduced equal to the amount of your Social Security at 62. So the reality is, back in those days, people didn't have a lot of money in the stock markets. There weren't all these sophisticated Social Security claiming strategies and filing and timing of Social Security things, because it was just so much simpler back then.
Well, yes, and I mean, I can remember even in the early 80s when we were working with our corporate plan sponsors, and they would talk about how do we communicate what we have as in terms of how people are going to live for the rest of their life. And there was what they used to call the three-legged stool, which was, and people don't talk about that so much because it's broken, but the three legs were Social Security, your defined benefit pension plan, your company pension plan, and your savings. So even back in the 80s, people were encouraged to have some savings on the side, some rainy day fund, if you will, something to supplement their income, as well as their Social Security, which was going to protect you against inflation to some degree, and your corporate pension plan. Now, those three legs are really, now maybe, you don't have defined benefit plans. Social Security is still there, but it's a little shaky, and people have very limited savings. If anything, they've got debt. On the other hand, what they do have, what a very large percentage of people have, is a home. And they have home equity. So if you look at your a person's entire asset or entire set of resources from which they can, live on. You've got your 401k or your IRA or your investment portfolio. And for many people, you've got a home where there's significant home equity. Now, the challenge is how can you draw from your home equity in a prudent way without, upsetting the apple cart or putting your home or your legacy at risk.
Or your survivors. We don't want to be in a
Exactly.
situation where your wife has nowhere to live.
Exactly.
So, well, and I want to get to that in a minute because I've delved into your research here before we jumped on the podcast. But let's go back to this one more thing on this 401k. It's really interesting, right? Because very few individual people, prior to the 401k plan being introduced to the Internal Revenue Code in 78, and I guess formalized, I think it was 80, it was 81 it was actually formalized.
Well, the regulations came out in the fall of 81. And in fact, I remember as an actuarial student at Hewitt Associates attending a session on the new regulations of 401k. And I was a defined benefit actuary at the time. So I was, we're studying to be a defined benefit actuary. And I attended this training session. I thought, why am I sitting here? And the senior actuary said, this is going to change your life and it's going to change the life of your clients. So you got to get up to speed on it.
Wow. That's interesting. I was 4 years old at the time, by the way. I was born in 77, in March of 77. So it's interesting to me, but nonetheless, if you look at it though, what began to happen is that all these dollars began flowing into a 401k plan, which the underlying investment back then was largely mutual funds. All right. Then you had the company matches going in as well. And slowly but surely, the defined benefit plans begin to phase out. But what was really interesting is you had all these dollars now chasing these stocks.
That's right.
And it caused the largest market melt up in history. In fact, over that 20-year period from 80 to about 2000, depending on what chart you look at, the return is over 1,000%. And that's like 3 times any prior 20-year period going backwards in that time period.
You're the expert on the investments. I just, like I said, I focus on the liabilities and I rely on experts like you who are expert in the investments themselves. And I'll just, I don't know why the big bull market happened, but certainly all of the demand for stocks that was generated by the 401k move was a part of that. Although, to be fair, a lot of those defined benefit plans, those pension plans, were invested at least, 50, 60, and sometimes even more percent in equities. So, I'm not sure exactly, but certainly people putting their own money in. I mean, that was, because, to really get the most out of a 401k, you really had to contribute your own money into it. But that was a great deal because you could put it in pre-tax and it would accumulate tax-free. And really, anybody who didn't take full advantage of a 401k plan, in that time really has only themselves to blame because.
Sure. And I mean, the company match alone is free money. Why would we not do that, right? People say to me all the time, Ryan, I'm concerned about the market crashing. I'm like, okay, listen, if you put in $1,000, your company puts in $1,000, you've got $2,000 in your 401k plan. Mm-hmm. If the market crashes 50%, how much money do you have left? Right. $1,000. You still have your money, even lost a dime. So take advantage of the company match for sure. It's free money. You should, right?
That's right.
So, what in that process too, Pete, is that what happened in my mindset is that retirement became a do-it-yourself world.
Yep.
Right. It's no longer, the onus is put on your shoulders to save enough, invest right, generate income, make sure it lasts your lifetime, claim your Social Security right. It just became a do-it-yourself world. So based on that, I mean, from your perspective, what are some things that people need to be concerned about? Like you mentioned the home equity thing, and I do want to get to that, but like, is there timing of withdrawals? Are there certain ways to get money out of your portfolio or certain products that you not recommend, or you're not that space, but some ideas that you have.
Well, you're absolutely right. I mean, what I saw, and when 401k, when the wave became a tidal wave and just a tremendous movement, I was involved with a lot of my clients, talking to them about the deal. Okay. And what the deal was, instead of getting a guaranteed pension, you as an employee will have more control and more opportunity to build your own wealth. And with that comes responsibility to how do you. And so there was a tremendous need for investment education among participants. And I think you and your colleagues have done a pretty decent job of educating the public as to what makes sense to allocate. And but as time has gone by, the options have become more and more proliferated. And now a typical 401k plan has potentially dozens of investment options. And it's tricky. It's tricky for a participant to choose among that and to figure out how to allocate. And that is not my business. I don't tell anybody how to invest their money. If pushed, I mean, I'll tell people how I invest my money, but I'm an actuary and I'm very risk averse. And
I mean, would you mind sharing? Because I would, as an actuary guy, I assume you're nearing retirement. Obviously, in 2016, you've done. I mean, would you mind sharing some things that you've done?
Yeah, sure. I mean, what I do is I'm all about I'm very risk averse. And I also, I know what I need. So once I figured out what I needed, then I can earmark, those funds, and I invest the way an insurance company invests. I invest in bonds, and I never sell a bond. I have a bond ladder that, every year, some bonds will mature, and I'll, spend some of it and roll the rest into a bond at the end of the ladder. And that's the way insurance companies invest. I mean, their general account is invested in fixed income that they hold until maturity. So they never have to be subject to those market losses or gains when interest rates go up and down.
That's interesting. That I like what you said. You know what you're risk averse, and you know what you need, right? And I think that's important, because I think oftentimes people get in a situation to where they maybe take too much risk going into retirement, and a big crash happens, and they make mistakes. Like I've got people that I talked to, as a matter of fact, earlier today. A lady had her portfolio largely invested in index funds, and she sold out at the bottom of the COVID crash.
Right.
And she's just now getting back to where she was, and she didn't realize how risk averse she was. She had the know what you need part. But her concern was she lost half her money, and now she's in a situation to where she's like, I had it covered and now I don't.
And I know we're going to get to this in a little bit, but I'm also a big believer in real estate. I mean, I own one property now, but I've had two and sometimes three properties, because real estate you can use it for so many things, not the least of which, if you have a second home or a rental property, for income. And so it's both an investment and a place to live and a place to borrow against.
Yeah, some of the biggest returns and hits I've made in my life have been on real estate, for sure. But let's jump into that. I mean, you've got a situation we're talking about using your home equity as an asset class to kind of tap and use for retirement. I mean, what are we doing here? I've got some ideas around this, but I would love to hear from you, kind of what your strategy is and your thought process.
Well, like I said, during the accumulation phase, as I was, building wealth, and and I had a house, the house would appreciate, and then I would refinance, and I would keep it leveraged, not crazy way, but such that the home appreciation, the appreciation on let's say $1 million house with a $600,000 mortgage, even the interest cost on the $600,000 mortgage is going to be more than offset by a pretty modest appreciation on the full value of the home. So that's during the accumulation phase. And now I don't need to pull money out of my home, but for many of my clients and many of the advisors that I speak to, who have clients who need to use both their home and or the equity that they built up in their home, and in many cases it's fully paid off, but they don't have enough in their 401k to live on for the rest of their life, then you can again borrow against that home. Now you can, and there are prudent ways and there are not so prudent ways to do that. But one of the best ways is what's called a HECM, or a home equity conversion mortgage, which is a form of reverse mortgage, which has had a little bit of a taint to it. But that was because back in the early 2000s, and then up to the financial crisis in 2008, a fair amount of people lost money on their equity, and the government, which backstops these reverse mortgages, also, paid out an awful lot of claims during the 2008-2009 crisis. But that business has been cleaned up substantially, and now, the government will guarantee a reverse mortgage, basically up to, I think, $1.2 million is the current limit on what you can access in terms of a reverse mortgage, and you can maybe we'll get into it a little bit later, but these new modern reverse mortgages are really wonderful vehicles, because you set up a credit line when you're at least age 62 or older, and then you just don't have to draw down on that until and unless you need it. And meanwhile, that credit line will grow. And again, you're only borrowing against maybe 40 or 50% of the equity in your home, or setting up that credit line. And as that credit line grows, so does your ability to draw down and use it for retirement income. And the government guarantees that you will never owe more than the home is worth, and your heirs will never owe more than the home is worth. So,
which I think is important, because in essence, if mom and dad are, and this is I'm just thinking about how I would use this, right? Because let's say we got $500,000 in a 401k between a husband and wife team. We got a home worth $1 million. I like what you're saying is go ahead and establish it now, because it grows over time, right? In the old days, the reverse mortgages, you couldn't do that because, right, the older you got, the better the reverse mortgage looked.
Right.
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 And so now you take that $500,000, they live on that as long as they can. And then we have to tap the home equity, in the form of a reverse mortgage. Then we do that as late in life as possible. But with the HECM, you're talking about doing that as soon as we possibly can.
Well, not exactly. Okay. Not as soon as possible. And that's where the research that Barry Sachs and I have done comes into play, because one of the risks in retirement, I mean, we talked about longevity, and that's a big one. You just don't know how long you're going to need income for. But another very big one, I'm sure you've seen it in your business, is sequence of return risk. Because, let's say and it doesn't matter so much when you're accumulating money, whether the stock market goes up 20% this year and then down 10% next year and then up 20 the next year and then down 10, you're still averaging a 10% return over the long time, and it's going to accumulate to a big number. But once you start drawing out of that pot, then the returns matter a lot. And if you're unlucky enough to have a big downdraft in the market right after you retire, and you're drawing down, you're just doubling down on a down market, and you could really run out of money quickly. So what we discovered, what Barry and I have been working on, is to use a reverse mortgage credit line almost like a buffer asset. In other words, when the market goes up, draw from your 401k. But when the market is down, don't draw from your 401k. Leave the money in the 401k to let it recover, but draw from your reverse mortgage credit line. And so and that's what we call the coordinated strategy. So if you coordinate how you draw from your reverse mortgage with how you draw from your portfolio, you can mitigate, and we've shown it in our research, almost entirely. You can eliminate sequence of return risk as a material risk in retirement.
That's really interesting to me to do it that way because, if you look at the number of times the market's being negative in a 3-year period, I want to say it's like 4 or 5 times in history, 2000, 2001, 2002 being the most recent time frame. And so to combat that, oftentimes we suggest people take, their income needs, right? The next 3 years worth, and let's put that into a savings account. Well, as you well know, prior to COVID, savings account rates were peanuts.
Right.
Right. And it's really fascinating to me that you guys came up with a way to use this HECM, right?
Yeah.
In place of that, because in essence, then you could have all the capital invested, maybe in some in dividend paying stocks, something getting a better return, better yield than the small amount of peanuts you're getting in high yield savings back then, and draw from the credit line in those times of need.
Well, and there's another factor here because, if you put it in a savings account, then, and as you say, the savings account is, 1 or 2%. And meanwhile, inflation is, if inflation spikes up as it did during COVID to, 9%, now that's you've really lost ground. If you have a reverse mortgage credit line, that credit line grows, and it grows at a pretty high interest rate. It basically grows at the interest rate that you'll have to pay eventually on the loan. So and that's could be 7 right now, probably 7, maybe even a little higher. So you've got a credit line that's growing at 7%, which you can draw on, versus a savings account which is growing at 1 or 2%. So a reverse mortgage credit line is a much better buffer asset in that sense than just a cash or a money market account.
That's awesome. So how did you guys discover this, and what was the mechanism to start thinking about this and looking into this? Was it just people have a large asset in their home, or?
That's actually a story you probably should talk to my partner Barry Sachs about, because it was back, it must have been almost 15 years ago that Barry was doing some. I mean, he's a tax lawyer. He's one of the best tax lawyers in the country, and he had retired, and he was just playing around and doing some research. He's a very he's a PhD in quantum physics. So he was a he's
really smart.
he's a bright guy, and he's always curious to explore different questions. And one of the questions he was looking at was the decumulation question. And I think he had read this research by, I'm not sure who it was, maybe it was Warshawski or somebody else, about using annuities and finding a way to balance out using annuities in combination or with other things to mitigate sequence of return risk. And he discovered, and he had found this about reverse mortgages back then. And this is again, I guess 2012, maybe 10, 11, something like that. And his first paper was called Reversing the Conventional Wisdom, and using a reverse mortgage to supplement retirement income. Well, Barry and I had worked together on a number of clients when he was a tax lawyer. He was the ERISA counsel for some of the clients that I was an actuary for. And so, we started, we became friends, and then we started to do research. And I looked at that first paper and I said, well, Barry, this is wonderful, but can't we extend? And he was just looking at one very, very specific case study. And I said, and with one particular ratio of home equity to 401k. And I said, can't we generalize this? Because this seems like a very general solution that basically anybody with a home and a 401k should be able to utilize. And so then we put out a paper, and I can't remember when that was, but we've since then we've done a couple of more papers. And one of the things that happened in that after that first paper was people said, yes, but what about legacy? Aren't you spending down? Don't you end up spending down all of the equity in your home so that there's nothing left to give your kids? And so we did, so we looked at that, and it turns out that it really doesn't impact the legacy that an individual will leave to their heirs. What it does do is it affects the components. So if you just draw down from your 401k, A, you are subject to sequence of return risk, and B, by the end of the day, you've exhausted your portfolio, and all you'll have is a house left to give. And let's say you have 2 or 3 kids. Now they have to split it up. They have to sell the house. They have to divide it. There's tax issues. There's transaction issues. Whereas if you take out a reverse,
they also all have to agree to sell the house.
Yes. And so if instead you take out a reverse mortgage and use a credit line and use that as a buffer asset, and then at the end of the day, you're going to be leaving your kids just about the same amount of total assets, but the assets you give will be disproportionately in the portfolio, which is a whole lot easier to split up. So, if instead of leaving a $1 million house and no 401k, you're going to leave a $1 million 401k and maybe minimal equity. You still have the house. If one of the children wants the house, they pay off the credit line or refinance the house and keep the house. But if they don't, well, you just sell the house, or the bank takes the house if you want, because if it depending on how much is owed on the house, and then the portfolio you can divide up between the heirs. And there's all kinds of there's these you would know better than I about these 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 inherited IRAs, and you can take out payments and roll over a number of years, and so from my perspective, it's better for not just the client, but it's better for the advisor, because the advisor as who's helping the client manage the portfolio, it makes your job easier.
Well, it does. I mean, and I like how you guys are using that, because in the end game, I mean, if I have a source to draw from when the markets are down, you are in fact mathematically increasing the amount of money that's left over in the end. It's that simple, especially over a 30-year, potentially 40-year, and now potentially 45-year long retirement.
Well, you got some people living a long time, I guess.
Well, I'm sure you've done some research. I mean, what have you seen life expectancies do from, say, let's go to 1975 to present day? I mean,
I tell you what's happened to life expectancy is very interesting. It's kind of got dispersed. I mean, it's so dependent on so many factors, like socioeconomic level, educational level, access to health, blue collar versus white collar. So there's as one of the things that's changed in the actuarial world for me is we used to have one mortality table for standard mortality tables that we would apply to every client. Well, these days, you might have a white collar table applied to one section of your workforce, and then a different to another section of your workforce. And then for people that are not in the corporate world, there's all kinds of different mortalities. But on balance, I mean, mortality has improved, and certainly in the upper, probably half to quarter quartile of the socioeconomic ladder, people are living a long time. I mean, I have a client whose whose mother is 110, and
Wow.
and and it used to, when I started in the business, mortality tables ended at 100 or 105, and now they're at 110, and but it is a brand new world, and medical technology has been just amazing for what it's done for us.
And drugs and procedures and they go along with it. I mean, the whole nine yards really is mesmerizing. My grandfather's 95. He's in a home in Asheville, North Carolina, and I was there visiting him recently, and I asked him, I said, "Pop, who's the oldest person in the home?" And it's a lady. She's 107. And I'm like, how is she to talk to and communicate with? He says, "Ryan, she's as sharp as a tack." So it really is interesting.
But there are problems. There are health issues that are, impacting a lot of the population. And so when you hit retirement, and that's one of the things that, I encourage, my clients and the advisors to advise their clients, is to really talk about your health. I mean, you got to look carefully at your health. You got to look carefully at your family history. You got to look carefully at, really, you can't really, it's hard to underwrite your own insurance, but there are people where, their retirement is expected to be a little bit less than others.
I'm a big student of the world of markets and how people do things differently across the country and the world. For instance, I have some clients, dear clients, they retired early and moved to Portugal. They've now been there going on 5 years. Loving life. I check back in with them all the time. I have a call with them tomorrow, actually. And they're going through the tax system and all that sort of stuff and learning a lot. And I know, and that experience serving them has taught me a lot as well. And I know you spent some time working in Paris during 2008.
Oh, yeah.
And during the financial crisis, and you saw some things different, some different feelings about risk and time and money. I mean, how did that, what did you see and how did it change your views?
Well, that year, I guess I couldn't have picked a better time. My company sent me over to Paris. I was with Watson Wyatt at the time, and Watson Wyatt didn't have a big actuarial office in Paris, but what they did have was a lot of executive compensation. There was, and their clients were basically the corporate global corporate headquarters people. And so I was sent over to Paris to talk to them about the executive compensation in America. And the Parisian management, they couldn't understand why they were having to pay their U.S. executives so damn much, even though they were losing money. And I had to, so I had to explain the different compensation structures. But I was the expert in the subject matter expert for non-qualified or executive retirement programs, and so that's what I was doing in France. And when I got there, I was starting to read I was reading the paper. The Herald Tribune was the only English paper in the office, and I was reading about what was happening to AIG, one of the largest insurance companies in the world. And I just couldn't understand why they were in trouble and they needed to be saved overnight. And so there was something was going very haywire with the mortgage-backed securities and the CDOs that were being pitched all around. And so I watched the whole thing crumble from Paris, and it was very interesting. The the Parisians, they were not as upset. I mean, I would have to fly back to Houston because one of my big clients was. I think you're in Houston, right?
Yeah, sure am.
Air Liquide was my major client, both in France and in Houston, and I would have to fly back, 3 or 4 times during that year. And when I landed, I was just amazed that people were going crazy. They were saying, "What are we going to do?" They were tearing their hair. People were, working 100-hour weeks trying to patch things up. And in France, they weren't. In France, they were very fatalistic about it. It's, well, times are going to be tough, but this year's going to be tough, maybe next year, but we'll get through it. So there was a very long view over there. And in France, you can't buy a house without putting 30% down. So you didn't have a lot of foreclosures and a lot of people. On the other hand, the banks were having trouble, and that was having an impact. But again, there was a sort of a fatalism and a this too shall pass attitude in France that really wasn't the case here in America. We kind of have to. There's a problem. We got to fix it right now.
So let me ask you this question. And you mentioned AIG, and this is something I studied quite a bit in the collateralized mortgage obligations and the tranches and blending subprime with A credit borrowers like myself and you, and selling that off, and the rating agencies getting paid because if Moody's didn't rate it, they'd go down the street to Weiss and they'd rate it, or Fitch would do it, right? It was a pay to play kind of game back then. But what was shocking to you in the moments of concern that AIG might fail?
Well, what was really shocking to me was this is a company that had been in business for over 100 years, and when I started, we started talking about Connecticut General, which is where I started Connecticut General Life Insurance, and my 2 years at Connecticut General gave me a deep appreciation for just how well run really large insurance carriers are. You don't stay in business for hundreds of years through wars and revolutions and pandemics without, having a very solid business model to take on risk, and their business was taking on risk. And so what I just couldn't understand is how AIG was writing these, providing these basically default insurance without adequate reserves. I mean, where were the actuaries? Why weren't they? And I didn't know. I mean, I was just reading what was happening in the paper, but that was what really kind of blew my mind is how could this happen to a big insurance company whose business is risk transfer?
So if, as an advisor, if I'm offering a client an annuity, for instance, and I'm saying, hey, regardless of what happens to the stock market, the economy, or interest rates, this, you put $100,000 into this annuity and you're guaranteed to get, I don't know, $500 a month for the rest of your life, and you're 62 now. Is there something that we can tell or share with the listeners in our audience that can kind of help them feel comfortable that the insurance company can, in fact, make good on that obligation to pay that $500 a month for 30 or 40 years?
Yeah. Well, I actually didn't finish telling you, everything I've invested in, because the other two things I have invested in is annuities. I have an annuity from John Hancock and an annuity from the Met. And I know John Hancock and I know the Met, and I know those guys are not going out of business, and they've got literally trillions of dollars in cash reserves backed up. And so if you're getting an annuity from a major insurance company that has been around and knows what they're doing, you really shouldn't have a problem. And backstopping the annuities are the state insurance funds. So and there have been annuity providers that have run into financial problems, but I don't know anybody that is don't think a single annuitant has actually lost money if they've gone with a, like I said, a reputable and solid insurance company.
Yeah, I remember back in the day of AIG because, rates were low. Okay. And so the insurance carriers were still hungry for capital. And so they started coming out with all these income riders. And you had, one company had an 8% guarantee of income. One had 8.25% guarantee. And it was a roll-up rate on a guaranteed minimum withdrawal benefit, all right, or a payout factor from this, calculation the insurance company was using to arrive at a future payment they would make, for your lifetime. And we would say that the money's, the income's guaranteed for life. And people had AIG fresh in their mind. Like, well, wait a minute, Ryan. What happens if this insurance company fails? What happens to my money? What happens to all these things? And we used to have to really, combat that. And that's why I'm so knowledgeable about what happened with AIG back in those days.
By the way, AIG did not fail.
They did not. You're exactly right. You're exactly right.
But to me, that was there have been insurance companies. In fact, I think it was the Equity Assurance Company of London, which was the oldest insurance company in the world. I think it was formed in the 1600s or early 1700s. And they went out of business in the early 2000s. And the reason they went out of business is because they were selling annuities at way too high a rate. And so, what you saw in the very low interest rate environments that you're talking about is you did see insurance companies stretch, and you did see insurance companies, providing guarantees and that were a little risky. And the one I have from John Hancock, for example, had a 7% guarantee roll up. And then once I started drawing it, I'm taking 5% of it out every year of the benefit base for life. But I'm not sure if John Hancock is selling any of those anymore. They backed their products, they sold it, and they're going to make good on their contracts. And that's the thing about insurance companies. A reputable insurance company makes good on their contracts.
And historically have done so in the face of some very tumultuous economic times, economic uncertainty, terrorism, wars. I mean, you name it, it's been out there. But that's what they're designed to do. They're designed to stand the test of time, which is why they don't do anything in most cases without hiring somebody like you. Pete, I bet I ask if you go to, how you drove to work this morning, you'll tell me that I went around the curve at approximately 15 miles an hour. My car accelerated to the apex, and there was 1.4 G's of lateral force to the right when my steering wheel turned 2 degrees to the left. And I'm not poking fun at you, but that's the level of detail that actuaries are designed to think at, and it's what you're trained to do. And so great people like you are behind this stuff, and it really is assuring as an advisor in a lot of ways, because the last thing I'm ever going to have happen on my watch, if I say, hey, listen, this product is going to guarantee you income for life, it's going to do that. I mean, that's the way it is.
Well, that's the business. I mean, the insurance companies are in the business of taking on risk. And that's the approach that I'm taking, and that I'm taking with my partners and my firm, Neuwirth Associates, is we take a risk-based approach to retirement income planning. Because, again, at the end of the day, I think retirement income planning is really cash flow matching. It's matching the cash flow that from your assets and your income with the cash flow that you're going to need. And that cash flow that you need is a very, very tricky thing to figure out. I'm not saying everybody needs to be their own actuary, but everybody does need to think about the risks to those their expense side of the equation when they retire.
Let me ask you this. And get your thoughts and methodology, right? Because I have a theory that, and I think I've seen it proven throughout my career. We do like a slow go, a go, a slow go, and a no-go year spending plan, right?
That's
because when you retire, every day becomes Saturday, right? What day to get your hair cut? What day to go to Home Depot? What day to go take your wife to dinner? What day you go to the movies? It's Saturday. And now every day is Saturday. So your spending kind of maybe increases some, right? but then it kind of goes up to here. And then you get into your slow go years where it starts going down back this way. And then your no go years, because your get up and go done got up and went, you really start to slow down. And my theory is that, the expenditure can keep going, a lower left to upper right trend if there's a medical issue or an insurance issue, right? Or, long-term care issue or something like that.
Well, yes. In fact, and again, this is the quibble I have with many financial planners. I mean, most of them are not even as sophisticated as what you're saying, which I think is right. I mean, that go, slow go, no go paradigm, I think, I don't know. The first time I heard it was from my friend Steve Vernon, who was who actually predated me when he retired from Watson Wyatt and started doing retirement income strategies. But the reality, the unfortunate reality, is that spending patterns in retirement are highly variable. Yes, there is a general people spend a lot more at the beginning when they're traveling and, and they're healthy and they can do things, and then less when they're a little more tired, and then a lot more when they have, some medical issue. But the fact is that this expense that you have to or you want to incur is highly variable. And so our current research right now is on what we call spike expense, which is, during, even with those patterns, you're going to have spike. Maybe you have to put a new roof on the house. Maybe your daughter-in-law is going into rehab, or maybe you have a big medical emergency. But when those spikes occur and how big they are and how long they last is another variable that you really need to, it's a risk. So there's sequence of return risk, there's longevity risk, and there's spike expense risk. And spike expense risk is among the hardest. I mean, in that category would be things like long-term care. And how do you pay for that? Well, maybe you insure it, maybe you use a buffer asset, maybe you do, you got to cobble together some kind of way to mitigate that risk.
That's, spike risk is very interesting. And we see that a lot with parents trying to help kids. And I have a saying at Allied Wealth: do not help your kids help you into the poorhouse.
Right.
Right. Okay. And I've seen it happen. But are there any other risk out there that you guys are looking at from an actuarial standpoint? You mentioned sequence of return risk, longevity risk, spike risk, anything else?
Yes, actually, the other one is tax expense, because it's how you manage your retirement income from a taxability and a tax expense standpoint is kind of a uncharted territory as far as I'm concerned. Now, this is where I have to rely much more heavily on Barry, because he is the tax expert. But one of the concepts we're looking into, I don't know that the numbers actually work, but Roth conversions is a way of ensuring, because if you take an IRA and you convert it to a Roth IRA, and what you pay in upfront tax, you can think of that as an insurance premium to mitigate, higher taxes, because we don't know what the tax rate is going to be on when withdrawals from IRAs. I mean, it's keyed off of whatever the federal government decides the tax rates are. So,
which is a moving target.
Right.
That's interesting. So, one of the things that we spend a lot of time talking about is taxes at Allied Wealth. And I actually believe that taxation will be your largest expense in retirement. I think it's larger than healthcare in a lot of ways. We also spend a lot of time talking about legislative risk. And, I know that you want to call them the Tax Cuts and Jobs Acts were extended, the Trump tax cuts, whatever. The tax cuts are here and they're staying. I don't care what you call them, right? Until we have another election cycle. And every 2 years, we have another election cycle. And what's been done can easily be undone. And we're in a situation where we're in the greatest, one of the, I think the top 3 greatest tax environments we've ever been in history. So there's another caveat that we've been doing. And I'm curious to I'd love to talk to Barry about this. Your partner on this too at some point in time.
Yeah.
But had a lady today, her husband died. Okay. So now she's got 1 year left to file a joint tax return. And my friend Ed Slott says that when that happens, she should convert every single dollar she's got in IRAs over to Roth IRAs, because this lady's 65, her mother's 95 and still doing well. She's in good health as well. She's got a long way to go, right? But she's going to move from a joint filer tax bracket over to the single filer, which means she's going to pay more income tax on slightly less income than she's going to have than she had when her husband was here. So, when we're looking at annuities, all right, annuities right now, because of the interest rate environment that we're in, are paying some pretty substantial bonuses. And these are the fixed index flavor, okay? So we're able to get this lady a 22% upfront bonus day one. And then you can be invested in the index account or the fixed rate bucket. That fixed rate bucket pays 3.75% first year guaranteed. So when you do the math and you look at the first year return, it's over 25.75%. So we take her money, we do the Roth conversion outside of this, then we take the dollars and put it into the Roth IRA, all right, get a bonus, and she's got, the majority of her taxes on this conversion have been paid by the insurance carrier.
Right.
It's mind-boggling. That's just a tool that so many people don't even know that are out there that exist, and just
That's right.
for where we are, right?
It's funny when Barry, Barry, like I said, Barry was a tenure track quantum mechanics physics professor at Berkeley, and decided he was actually, they wanted him to, he'll tell you the story if you ever have him on, but they wanted him to do experimental. Teach experimental, and he's a theoretician, and so he didn't want to do that, so he quit and he became a tax lawyer. And what he says is, it was interesting because taxes is in some ways more complicated and more interesting than quantum mechanics, and so you really do need to be an expert in that. And again, that's his lane, and I try to stay out of it.
Yeah, it's interesting though, Pete, because we get a lot of clients and they'll go, Ryan, you're talking to me about Roth IRA conversions. And I go talk to my CPA and they tell me to go talk to my financial advisor. Right. And then we have a lot of firms out there that we get business from because the clients realize that their offering is not as robust as something as Ally Wealth is, in the sense that the advisor tells the client to go talk to the CPA about the Roth conversion. And the CPA tells the client to go talk to the advisor about the Roth conversion. So they're like ping pong.
Well,
paddles.
This essentially is why, Barry and I decided to, form a company. And that's, that's where Neuwirth Associates came from, is we want to be the advisors to the advisors, because, like as you say, not every advisor can be an expert in, the latest annuity products, the latest insurance, these, how spike expense risk really operates, reverse mortgages and so forth, and taxes. So what we try to do is to be a resource for advisors who need, some more sophisticated analysis of some of these strategies that you're not going to get from a CPA or a CFP or pretty much, you need a couple of, professions putting their heads together. And that's what we've been trying to do.
That's awesome. So, what is the book that you wrote was originally the What's Your Future Worth and Money Mountaineering. Let's talk about those for a few minutes. A little self promotion here.
All right. Well, as I was coming to the end of my career at Towers Watson, I just started putting down, I thought it would be helpful. I thought the actuarial perspective has really helped me make a lot of good decisions in my life, and not just financial, but otherwise, because I imagine the future, I imagine the possibilities, I look at the scenarios, and then I judge, the impact today of something that's tomorrow, and how do I value what happens tomorrow versus today. So I wrote that first book, basically how to use the actuarial perspective to make better decisions, life decisions, money decisions, all kinds of decisions, medical decisions. And it did okay. But what happened was everybody kept asking me, but what do I do about my money? Where do I put my money? What do I do with my 401k? When can I retire? So I thought, okay, let me write it. So I wrote another book. And this one was all about money. And it's basically, the world of money, what is money and how to navigate through it. So, if anything, money mountaineering it's sort of a trail map through the world of money. And I'm not going to, like I said, I'm not going to tell you, what to do with your money. I'm just going to tell you kind of the lay of the land, and money, and it's complicated and nobody understands it. It's uncertain. Nobody know what's going to happen. It's noisy because lots and lots of people are trying to tell you what to do with your money, and not everybody has your best interest at hand. And as human beings, we're really not programmed, or not cut out to evaluate fixed versus variable rate mortgages or whatever. And so that's, that was the second book, and that one's done much better. And that's what has allowed me to, like I say, build a consulting practice around it.
That's awesome. Well, Pete, I'm going to ask you this, and we'll wrap it up here as we're running out of time. And I want to tell you, it's been an honor to have you on, and I've learned a lot today as well, which I often do. And I enjoy being around great men like yourself who just are gems to our industry, into the financial markets and retirement planning, that sort of thing. But, from an actuarial standpoint, when do you think someone can retire?
You say when?
Yeah, when? I mean,
well, I think actually that's the whole notion of what is retirement. I mean, retirement is a kind of a poorly defined concept, because I think it's when you stop, maybe when you stop working for a company. Well, that doesn't mean you have to stop working entirely. And so I think it just is, it depends on the person, and it depends on, what you like to do. I mean, I like to, I'm still making money. And I've still got a few other little side gigs which will generate income. But what does retirement mean? Not doing anything to make money. So I don't really know the answer. I guess, once you're, I don't know. I mean, I think it depends. It depends on.
And I agree. And I was just wanting to pick your brain there, because to me, it's, it can be about a point that you reach to where you have enough to where you no longer have to work for your money. Your money can begin working for you. That might be one.
Yeah.
Right. But the other one is when you figured out, hey, what am I doing? Where am I? Who am I with? Right. And you remind me a lot of who I'll be in my later years of life, is that I don't think I'll ever stop working because I love what I do. And I get that from you, by the way.
Well, I think it's the fourth largest asset that most retirees have. It's the present value of their future part-time earnings.
Present value of your future part-time earnings. That's interesting. That's very interesting. I like that one. I like that one a lot. Well, Pete, I can't thank you enough, my friend. We're out of time today. I'd love to circle back with you and talk with you about having Barry on. I think that could be a wonderful episode as well. Right.
It's really been an honor. I really, you got a great podcast, and I've watched a few of them, and you're terrific. And I've really enjoyed being here, and I hope we stay in touch.
We certainly will, my friend. I'll have you on again soon. Thank you so much. Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.